Sunny Coast, a couple of Sydney siders, a couple of Newcastle fellas. I just
Lovely.
heard a little beep, so that means I've taken a little bit of profit here. But yeah, so guys, we obviously wanted to get just trying to take some money back off you fellas, Conor. We thought we'd get Conor on just to have a bit of a behind the scenes glimpse, hopefully, into what happens behind the curtains of a CFD provider. So I'll give a quick kind of overview of how I know Conor. But he was my account manager at IG. You were CMC before that, I think, mate.
Yeah, I was. Yeah.
So I worked in obviously the two of the big two providers in Australia. Joined Trade Nation. When was that, man? I still remember getting a call from you. I was on my balcony in Crete last year, so it would have been April or something like that.
Yeah, so I think I left IG, or my last day I had gardening leave, but my last official day was the end of April. So yeah, I've been at Trade Nation since around the end of April. So coming up to sort of my 1 year anniversary soon.
You pass your probation, mate, do you think?
I think so. I hope so. I'm still here.
So, but yeah, I don't want to kind of blow his head up too much, but like I've had probably 20 account managers, and I can honestly say Conor's far and away the most responsive and most knowledgeable that I've had. So I think it's worthwhile getting him on to have a bit of a chat. And sorry, there's a bit of feedback coming through. So good chance if anyone has any kind of questions as to what happens. As I said, behind the scenes, etc. But do you just want to give a quick overview, Conor, of where you're at, how long you've been in the industry, etc.?
Yeah, no, thanks, mate. I appreciate your comments; they're very kind. So, so basically, I'll give you a bit of a background. I mean, actually, I was an engineer before I came into markets. I did that for about 2 years. I've sort of always traded, but I didn't enjoy it as much, and I loved the trading. And then managed to get in at CMC, so I was starting client services. I was in there for sort of about 9 months. After that, I got sort of promoted into the sales team there. And then I think I was in the sales team, pushing up to sort of 1.5 years. So that was taking me to just over 2 years. Oh, sorry if you can hear some noise in the background as well. I'm working from home, obviously, and they've literally decided to start building scaffolding right outside my office window. So sorry if you can
that's probably what
sort of banging around. So then, and then I was just sort of moved across after that to IG, to their premium desk. And then I was there for about 2.5 years. And then that takes us to sort of April, and then I've moved across to sort of Trade Nation after that. So sort of to cut a long story short, but yeah, it's I mean, look, CMC and IG are I'd say two of the sort of the biggest CFD providers or spread betting in the UK globally, definitely, and ultimately, they're very good at what they do. I think one of the great things about working for like sort of CMC and IG was their massive size and the amount of knowledge that you can build up by working with those providers, by doing what they do. And that's also, I think, their downfall as well. They can't, with all these new sort of providers up and coming, then they're sort of not as nimble and as dynamic because they're so big. So everything has to sort of pass up the chain, and being on the phone with clients sort of every day, and sort of, I suppose, being on the front lines, as you could say, you sort of learn what traders want, what they need, where improvements can be made. And then with these big firms and companies, they've got their sort of plan, and they don't necessarily sort of listen to their traders as much as they used to, I don't think. And coming to work in a much smaller sort of firm like Trade Nation, it's much more nimble, it's much more personal with the traders individually, and trying to meet their sort of individual needs rather than creating like sort of everything under one roof for everybody and making it accessible to everyone. So I suppose that's sort of, one of the benefits that I enjoy at Trade Nation. And And yeah, so far it seems to be going quite well.
And mate, what do you like? Sorry, go on. Who was that?
No, I think it's just feedback.
Oh, feedback, is it? Yeah, I think I'm getting feedback from someone there.
Your speaker on? No, you've got a headset on.
Mate, the question that I get asked I guess the belief that most people have with you guys is that like you're on the other side of the transaction, you're kind of there to steal our money, to stop us out. At my $1 contract, you're really targeting in on that, and you're trying to wick me out. What is there any truth to that, mate? How does it kind of work behind the scenes?
Yeah, so it's how it works behind the scenes is obviously, yeah, we are on the other side of every trade, and people are always like, you're following my trades, you're moving the price to stop me out and everything like that. But I mean, if that was happening, the regulators would come down hard on us. But how it actually happens, so what really happens is, if you've got thousands of clients globally all trading at the same time, you've got somebody going long and somebody going short. So let's just say, for numbers' sake, you have somebody go long $1 a point on the ASX, and then somebody else go short $1 a point on the ASX. They've what's called naturally hedged each other. So therefore, we wouldn't have to go to market and hedge that trade, because two clients have hedged themselves, and then we can take our cut of the spread. Now, that's obviously in layman's terms. You've got this happening with thousands of clients sort of globally across many different products. And then obviously that's fed into the algorithm, and then that works it out, and then it spits out sort of onto a risk dashboard. And yeah, like there are limits. So if we go over a certain amount, if all of our clients go long, if they're long over a certain amount of points, then we're not willing to take any more risk. And then we go to the market and hedge that. So we're not sort of following any individual trades at all. But that doesn't work like that. As I said, it's all done on a big risk model. You'll find actually indices is a really interesting one. Indices, a lot of clients, you find 50% of clients are long and 50% of clients are short. Obviously not always the case. So that's like you don't need to hedge as much on that product. But shares, for example, nobody likes to short individual shares. People love to short an index, but they don't like to short individual shares. So you'll find that 95% of clients on shares are long, and that requires a lot more hedging, where we go to the market and then obviously we'll do what the client does. So we buy, and then we copy what you're doing. So then if you make money, we make money, and then you get the money, and then we take our commission or our spread on those trades. So there's no that. I think I have heard some horror stories. I think like 25 years ago, I think when regulators weren't as hot on CFD providers, and it's open information that's out there, that I think that there was the occasional stop hunt, from what I've heard from these stories about 25, 30 years ago. And I think that's sort of given CFD providers that bad name, but that's just completely stamped out. Does not happen at all anymore.
And Conor,
and how is your
sorry, you go.
Sorry, mate. How is your relationship with the regulator, and what are your kind of views on, obviously you see on everything that 70% or 80% of traders lose money, etc. Like, what's your view on the regulators and how kind of strict they are with that, and then also the fact that most traders do lose money?
Yeah, I think we have a pretty good relationship, with the regulator. I think it's a case of, from some stories I've heard, it's a case of the regulator just trying to protect, people who don't really know what they're doing, and then end up losing, all of their sort of life savings because they've never traded on leverage before and they don't understand the products. And I think that just the regulator is trying to protect those people sort of by getting into doing what they're not qualified to do, or where their education doesn't allow them. If you've never traded before and you go into the market, I mean, I personally myself, when I first started trading CFDs, for example, I knew nothing, and I'd go and I was trading on oil, and then I was margining myself up massively, and then I was just getting stopped out and losing my money, and I was like, well, I don't know what's sort of going on here. And people, you just click, you're like, yep, I want to trade, I want to do this, and then boom, all of a sudden. So I think that's what the regulator's just trying to do, is trying to support the people who don't know sort of what they're doing as much. And then if you've got the qualifications and you have traded before and you have got experience, they've obviously allow you to upgrade to sort of that pro account, which does allow you to trade on those high leverage. But, we work very closely with the regulator and everything. And I think, they have good intentions at heart of what they're trying to do.
Knowing what you know about how a market maker will hedge if they get an imbalance between the buyers and sellers, does that change how you interpret price action? Do you see that on the chart, or is it too small in the scheme of, say, an indice?
Yeah, well, we can't. It depends. Like if you've got one client coming in and doing a massive trade, for example, like we'd work that through the day on an algorithm. Like, so if client's doing a massive trade and the volume's not there, we can't just go and buy it on the market and drive the price up. That's we'd get a tap on the shoulder to be like, look, you're moving the price. You can't do that. So depending on it's how it works is when you look at a risk monitor, for example, when you're getting close to your risk limit, the algorithm will start to passively hedge in the market. Because we make our money on the spread, when we go to the market, we don't want to cross the spread in the market, because then we're just eating into our own profits as such, and that becomes what's a hedging cost. So the closer we get to our risk limit, we'll passively hedge where we sit either side of the market, depending on which way we need to go, obviously. And then we want somebody to come across and meet us on the other side. So we're not going and just buying at market. We'll rest an order on one side of the market, so somebody will come across and fill in our order. Then we can capture the spread or more of the spread. If it then breaches that, we'll go in more aggressively, and then we'll buy at market to bring ourselves back in line with our risk limits. So there's not really a point where you're going to see some huge price action where you're just like, oh, that must be a broker hedging their trades. It all happens gradually, little bits here and there. And if a client rings up and he wants to do a massive trade, then we'll just say, oh, obviously we'll have to work that throughout the day on the algorithm, but these guys know and these guys understand that. Obviously, then we fill them, book it to their account. So we'll go sort of, we'll hedge directly in the market straight away, depending on the size of that trade.
When you see, let's say if you were looking at depth of market, you see someone whacking the bid, but it's just not lifting, is that probably something you think, man, there's a large order, someone like yourself who's a market maker might just be sitting there passively absorbing? Is that
no, not necessarily. I mean, there's a lot of algorithms as well out there where people just sit on that side. They just want to make little bits of profit here and there. So that could really honestly be anything. I've had it as an example. I do a little bit of trading myself, more longer term stuff, and I was trying to this one time it was for a client. He was trying to get out of this position, and so I was having to trade for him in the market, and I was trading against an algorithm. And every time, I was putting in my price, an algorithm comes in over the top, and I would keep changing it, and I'm like, oh wow, I'm literally going against an algorithm here. So that could be anything, really, to be honest with you. I mean, if you look like a market maker hedging in the market compared to the whole massive size of the market, I don't think that you would really notice a market maker hedging. When you think about all the funds out there, and even if you think just in Australia, for example, I think super funds are worth trillions of dollars. So I think there's just so many market participants out there. It could really be anything.
And Conor, your liquidity, mate, I think you remember you saying that there's 3 kind of main liquidity providers that most of the companies use. Is that right?
Yeah, so you have obviously the likes of IG, CMC also provide liquidity to smaller brokers, and then IG themselves, they'll get their liquidity straight from the banks. I think from memory, mainly use JP Morgan and UBS, and then CMC get their liquidity from the banks. and they're mainly from, I can't remember who else they use, but they mainly use Morgan Stanley, I think.
Yeah. Okay. So just as an example, mate, can you just press the mic button when you're not talking? Have you got the platform up?
Oh, me? Do you want, as in mute myself?
Yeah. Can you just mute yourself just when you're not? Yeah. Perfect. Now I'm not hearing myself. So, mate, just as an example, like was it last week or the week before with the US CPI? So obviously that that slipped or gapped or however you want to say. I think it was 30 or something points with you guys. And I know one of the other brokers sent me the same thing, and I think theirs was 50. So obviously that can change and whatnot. But would that be because they are getting liquidity from a different provider than you are, or how does that work? And what about obviously you guys promote the fixed spread side of things. How does that differ for another broker that has variable spreads?
Well, that could have been the reason why it slipped that many points, because we're fixed. So we were at 30, and obviously something gapping 30 points is an incredibly volatile market. And during the volatile periods, brokers will widen their spreads, and that could have been a broker slipping you 30 points, but then their spread is widening by 20 points. I mean, that seems like a lot, but it can happen in the blink of an eye. Because what happens if you've got an order resting in the market, what happens is when the price crosses your order, then your order activates sort of as such, and then you'll be filled in at the next price. So then it goes into a market order. So I think what it sounds like is that I've got a chart I can show you a bit later of how brokers widen their spreads during those volatile periods, or especially during news releases when they're expecting things to move so quickly. So I don't know exactly why that would have happened, but as I said, like you can, as I said, sent through to you, saw that Bloomberg screenshots and the bid ask, jumped by 30 points. We've got a fixed spread, so you still continue to pay what you're going to pay. But then I think what it sounds like is the other broker must have widened their spreads at that time, and then you've got slapped with that spread fee, and then the slip of like 30 points.
And is that a predetermined spread, so to speak? Or does it happen depending on the move and that spread is decided after the move?
So that's a good question, actually. What brokers would tend to do before a release, they'll normally have like loads of data on prior sort of releases, and depending on that release and what they're expecting to, the broker will widen their spread by a certain amount. So they'll just say like 10 seconds before, they might just type in 5 or 10. But they'll have it's not just whoever sat on the desk that day randomly comes up with it. They would have had loads of data in the background that tells them how much they're expecting the market to move by. And then they widen their spread based on doing that. Now, the reason why they widen their spreads is what all the brokers trying to do is just protect themselves and then protect their risk book. Because if the market's incredibly volatile and then everybody goes long on that, and then everybody goes long, you get in on that price, and then the broker hedges 5 seconds later, that broker's just lost all of those points. So it's like them just passing on sort of that cost to you effectively is what's happening. It's not to sting you. It's not to make you worse off. It's literally just that broker protecting themselves from, they're just passing that risk back onto you as the trader rather than taking it on themselves as such. So I'm pretty sure I know how it works at IG. CMC is probably very similar, but yeah, it's all data crunching, how much they think it's going to move based on what's happened over all of these years, and then it will get changed depending on the release or whatnot. Could be a few minutes before, could be a few seconds before. It depends on the product as well.
Well, mate, one of the crazy things that you've said to me was, and I'm not sure if it's still happening, but it was with one of the big guys that you previously worked with, was during that period, there's actually someone physically sitting there hedging the risk, if I remember that right. And I just could not believe in this day and age that there's actually someone, going second by, because I think I was trading with one of these guys and it was through CPI or one of those, and it took like a minute for my order to kind of be processed and worked out where I entered and where I closed and whatnot. And you said there's physically a dude sitting there trying to manage that risk.
Yeah, exactly correct. So I won't name who it is or what company, but it's like, you know, when you're some of these systems, these brokers have been around for nearly 45, 50 years, and their systems are sort of so old, but they're built in such a way that they don't want to touch it too much or change it. So how it works is, or how it was working there, is around like a CPI or whatever. You know, you could be doing a $1 a point trade, or you could be doing $100 a point trade. But what would happen is all of those trades would get clumped into one big trade, and then they'll go to a risk dealer on the desk, and then he'll fill it at the market, and then that price will get passed on to you. Now, obviously, this is happening in the space of, you would hope, 15, sometimes 30 seconds, sometimes obviously a minute. In this case, because it depends on the size of how many people are trading, how big those orders are, how long it takes them to fill it. Now, you could be slipped in your favor as well in that time, but you could also be slipped. I only hear the bad stories when clients have been slipped, not in their favor, because they want a better price. When it gets slipped in their favor, you never get a call when that happens. So I've only ever had the bad side of it. So, but it's all the brokers then going to the market, filling that, and then just passing the price on to you. So, you're not being shafted or hard done by, right? That is the price that this was filled in the market, and that was given to you. Now, the process of how those orders are filled, is obviously up for debate whether it should be done a bit better than that. Should you be clumping $1 per point orders with $500 per point orders? That's another question, of course.
And with that discretionary timing, is there frequently days, around news releases or whatnot, that a big market maker will actually post a loss?
Well, technically no, because they're sort of hedging directly in the market straight away. So because you're getting the price that they get, as I said, they're just passing that risk back onto you, so they don't have to wear that loss.
Okay. That's good.
And mate, what about looking forward? What's the evolution of CFD trading, do you think? What do you reckon the next few years kind of holds?
Oh wow! I don't know, I think it'll be an interesting few years. I think the regulators are really, sort of digging deeper into more about sort of CFD providers. But I think, to be honest with you, I think that's only a good thing, because there are some providers out there that you shouldn't be trading with, and I think it will. They're trying to weed out the brokers that aren't. I mean, I can't remember the name of the firm, but it was, I think, a few years ago. I think it was just after COVID. You can Google this and read it. And this firm was just like running, not a Ponzi scheme, but they were like running it like the Wolf of Wall Street. Clients were wanting to withdraw, and then they were ringing those clients up and giving them incentives to keep their money in the account. And if they want, I said, oh, well, it's going to take you 2 weeks to withdraw your money. They had like massive gongs in the office, and they would smash the gong when they get a sale. And all of this stuff, I know it was literally 3 or 4 years ago, something like that. And obviously they got massively fined and shut down. So I think that what ASIC are doing is only a good thing, if you're doing the right thing as a broker, because I think CFDs are a great product that have been given a bad name due to sort of clients losing money. But 70% of, as you said, 70% of traders lose money. But that's not necessarily just for CFDs. That's just trading on the stock market with your own money as well. And I think CFDs are a great product if you're talking about trading on leverage. If you can go and get a margin line if you want, and trade on that, and you're going to be paying a premium. So you're going to be paying off the top. We charge 2.5% admin fee, and then you'll go off the I always want to say the LIBOR rate, but it's not the LIBOR rate anymore, the SOFR rate, or depending on wherever you are. But if you're looking at, what would that be roughly? Let's call it 6.5%, something like that. if you're going to go and get a margin loan, you're going to be paying 8%. And you're going to be paying that margin loan every day, even if you don't trade on it. Whereas if you're trading on CFDs, you're only going to be paying when you're holding that position. And it puts everything into one platform. You know, a lot of my clients as well, and they love like CFDs because it's putting all of the products into one platform and you have one margin. If you were to go and trade on the markets, you're going to have an account with multiple different brokers to give you access to multiple different exchanges, because you've got to do commodities, you've got to do FX, and you've got to do indices. We have all of those accounts. We put all of it into one. You have one margin, and then you go from there. So I work in the industry, so I think it's a great product. But it's for me, it just makes sense if you can trade multiple different products within one platform. And I think it's very well priced as well. So,
can I ask a question?
Sorry.
Yeah.
So you're hedging your book basically with index futures like AP futures or whatever, like SPY futures, right?
Mm-hmm.
That's basically how you hedged it out. So what impact do you think the CFD providers like in Oz, or like everybody who, you know, all the CFD providers on who are offering like Oz 200 actually have on the actual futures, like flow and price? Like what would it make up?
Wow, I mean, that honestly, it purely depends on what your clients are doing. As you know, if you've got 50% of your clients long and 50% of your clients short, there isn't any need to go to the market and hedge, because you're naturally hedged in the market, which is you're naturally hedged with your clients. They've done that themselves. I mean, obviously that's the ideal scenario. It doesn't happen perfectly every time. So that's a very difficult question, because it purely depends. That would change from day to day. You could have one client come in and trade $1,000 a point, and then all of a sudden $1,000. Then that broker's going to have to rush to the market and start hedging those trades. And on that day, they could have done a lot of volume. And then, you know, the next week they don't go to the market at all because they don't need to. So that's a very difficult question to answer, because it purely depends on what your clients are doing and whether they are long or short. I wouldn't know. I'd just be randomly guessing and throwing a number out there, but it would change massively day to day for sure. Like shares, for example, brokers are a lot more active, or CFD providers, market makers are a lot more active in the shares market than in any other market, because, as I said, that's where clients will go long and don't like shorting individual stocks for some reason. So that's where you'd find most of the volume from CFD providers is definitely in shares.
Conor,
and Matt, I know
sorry,
just on I know Ziggy trades the underlying SPY, and I guess what I hear a lot from guys that do trade that is like, and Ziggy can correct me here, but they kind of don't. Obviously, there's benefits for CFDs in terms of that you don't have your, you know, that margin tied up, whatever it is, 75 grand or whatever a point in the physical market. But I guess there's a bit of they're a bit doubtful of that the CFD market is trading the same as the SPY market. There could be some, you know, manipulation or a little bit different there. Is that what's your kind of thoughts on that?
No, I mean, like there's no market manipulation happening, because we get a tap on the shoulder from the regulator. Everything's tracked and traced with trades. You know, now it's done, and it's happened sometimes. You know, so I'm trading like for a client. You know, obviously sometimes you're like, whoops, I shouldn't have done that, and people make mistakes, right? But in terms of like actual like market manipulation, no, I'm definitely not, because you'd be in massive trouble if that was happening, and it's easily you can see that happening in the markets.
I'll put it another way. Mate. Is there a benefit to trading the SPY, the physical SPY, versus say the Oz 200 through a CFD?
It depends on what you want in terms of visibility. If you're putting orders in the market and you want to see where you are in the queue, then yes, that would be the benefit. Like, you can actually see your order in the market and see where you are in the queue, and when you could potentially be filled. I would say that is like the visibility would be the benefit. If you're trading with a CFD provider, there is no queue. you know, once it hits that price, you're going to be filled on that price. You have with the CFD provider, there's also a cash product as well, where it's the price is market made from the futures price. So if you remove interest and add dividends, which is called a fair value, then you'll get yourself to a cash price. So that tracks basically the futures price. Benefit of trading a cash price is that it's purely market made. It's not available on the market. You can only trade the futures. Is that the spreads are a lot smaller, so it can be a bit cheaper. But as I said, like from clients that I've spoken to before, you know, they like to be able to physically see their order in the market, and they like that visibility. It makes them feel safer. And, you know, I'd say, you know, that's everybody's preference, especially when it comes to trading. You know, it's you got to be able to trust in what you're doing and who you're trading with. It's a big part of trading. You know, there's a lot of money on the line here sometimes. So
that's my kind of view of it as well, Marta. I think really, it's like my trading style was based around the order book, so I need to be able to see the SPY order book. And like, you know, I mean, I certainly used to be just like capturing like 4 or 5 point moves in the SPY. Like I don't do that so much anymore. I did that for like 10 years and was profitable, but I like can't be asked to do that as much anymore. It's kind of like, you know, it's kind of tiring mentally. But I still, having said that, I still trade the SPY like directly through the order book, and it helps me kind of see what, you know, the momentum is and what direction it's moving in, and that's how I kind of learn to trade. To me, the big disadvantage is the amount of capital tied up, as like Marta mentioned, because, you know, it's like intraday margins like 12 grand for one contract, right? So if you're,
yeah,
you know, and then you need a significant buffer as well. So if you're trading multiple contracts, you need a bit of cash on hand, which is kind of annoying. And I see that as a major advantage of CFDs. But
yeah. But what you can do is, you know, we also have you can also trade futures. So we have the SPY futures available as well, and that right. tracks the price directly. You'll have we charge 1.5 points when the market's open, so you can still look at the order book of the SPY and have, you know, your order book on one screen, and then, you know, trade with the CFD provider on the other screen, and then you're still trading the order book because you can put your order in. You can't see where your order is sat in the queue. But if you're trading off an order book, you can still have that open and then put your orders into not into the market, but onto the product essentially, and then move your order as the order book is changing, how you would do normally anyway, and then you can get filled quicker as such.
So sorry, mate, just to confirm that, if you traded the futures, say through Trade Nation, for instance, is that physically going into the market though? I know you say you can't see your order in there, but is that's not physically on the
not physically,
it just tracks the price. Yeah,
it's exactly like mirrors the price exactly. So if the SPY futures move down a point, we'd move down a point. It's literally it's basically a direct feed from the market, but your order just doesn't go into the market. So, you know, if you want to trade off an order book, you can have the order book, and the price on Trade Nation SPY futures is going to move with the ASX SPY futures, like exactly the same.
I just got a question. It's a bit different, but I read a few years ago, I think Tom Hogard put out a study from CMC, might have been CMC, but it was a big firm, and they mentioned that most of their clients on a percentage basis are winners. However, the reason that most traders lose is because their losses are just blowout. Is that sort of consistent with the data you've seen?
I don't know. I've never seen data on that, but I can confirm that would make sense for sure. I would say that's the trader's biggest mistake. Is they don't cut losses. I've spoken to clients before, and it's like, oh, it'll turn around, and the issue with trading like that is, like, to be honest with you, 90% of the time it makes it. But all you need is it one time to not turn around, and then all of that hard work. You know, I've spoken to traders. Their margin liquidation is their stop loss. So they're just willing to put all of their money on the line every time, and then they've got to just build it back up again. So definitely, from the conversations I've had with people, I would say that is definitely most likely happening, but I couldn't confirm. I've seen no data on it, but yeah, it's with trading, right? You know, you've got to put your ego aside. You're not going to win 100% of your trades, and you know, and if you cut your losses, you know, I've known clients that lose more trades than they win, and they make money. You know, that some of these guys will operate on a 10-to-1 reward risk ratio. They need to win 11% of their trades based on that, I think, and then they'll make money. When they lose often, and then they'll just win big, and then boom. And each their own. You know, some people win more trades, but you know, do lose a bit more money, but they control their losses. And I'd say it's controlling your losses to make it fit how you want to trade and what your trading strategy is. There's so many strategies out there, it's insane. But if you can find something that works for you, but like I always say to people, trading 101, risk management. Risk management is the most important thing in trading. 100% for sure. If you don't control your losses, all you need is one trade to go against you, gone. See you later.
Yeah, actually, that's what my stats showed me. Right, I back tested this with Motive Wave with just a really simple strategy where it basically just, and it doesn't really matter what the strategy is, right? It just bought the market when there was a certain amount of point drop, right? And then I basically back tested different profit targets and different stop targets, right? And also different amounts of like initial point drop for the entry. And basically, there's more than one way to skin a cat. If you basically allow a really big stop loss and a small profit target, it puts your win rate percentage right up, and you can get that as high as like 90%, right? But then when you get drawdown, the drawdowns are much bigger, right? And if you go the other way around, then the reverse of that happens naturally, and that's just like statistics, right?
Yeah.
Basically, if you just do that with just general market drift upwards and you only do it long, whichever way you do it, it will be profitable. The only difference will be the size of your drawdowns and whether you can handle that. But I mean, and that was based on data back to 2000, which is the only I had. And it was based on, I did it both on SPY and on ES as well.
Oh yeah. No, that is it. Actually, I've never actually sort of run the numbers on it. I see a lot of these guys, and it's like I said, if you exactly right. You know, if you does it make sense if you go one way or the other way? It's a lot of trading. You can just put it down to data and statistics. 51% of the time, this happens. You know, all you need to do is have a reward risk ratio of 1-to-1. Sorry. And then then you're going to ultimately, if you bring it down to data and statistics, that's clearly correct.
And obviously, that's what we're trying to do in this room. And Beau will probably back me up that we spend most of our time probably talking about the risk management and how to get out of a trade more than we speak about the golden pot, and how much money we're going to make. So. But mate, we'll wrap up in a minute. But give us a horror story and a buy the yacht story if you got one for the last few years.
So I'll start with a horror story. I don't know if it's going to be like that much of a horror story, but I find it quite funny and interesting. And basically, when I was at CMC, obviously we're going to the market, and we're hedging in the market. And when you're trading in the commodities futures market, if you're buying oil, you will receive oil if you hold that to expiry. You've got to then receive all of this oil. And CMC were long. I don't even know how much. Like it had a long position, and the futures expired on it. And then they were being threatened with having to receive all of these thousands of barrels of oil. And then it's just like, well, I don't know where we're going to do, what we're going to put it. And, there was a lot of stress and panic. And it was just obviously an honest mistake. Someone was like, shit, I didn't close that position out. And then, anyway, luckily they managed to, sell it off market to somebody that wanted to actually buy some oil. So it's quite funny when you're trading on futures markets, and a lot of people don't realize this because obviously you're not trading directly into the market CFD, so you don't have to worry about any of that. But all the brokers have to worry about that, and it was quite a funny time and stressful time when CMC they got all right, you're gonna have to receive thousands of barrels of oil. Like, shit, we don't know where we're going to put all this. Like, what are we going to do? But yeah, no, they managed to ship it off to somebody else in the end.
And that's why you got fired from CMC, is it?
Yeah. Yeah, so, oh no, I left, well, yeah, no, there you go, yeah. Take the oil with you. So no, that's always one of my favorite stories, and that's one thing you do have to worry about if you're trading on the commodity futures market. I suppose another one is there's I can't remember the exact numbers, but I know this one guy started his account like a few $1,000s, and this was before the wholesale pro regulation came in. So I don't know about his trading experience. I wasn't his account manager. I know this story is true. Anyway, he deposited a few $1,000s and just went, margined himself up massively. Anyway, and he just got lucky, or he's a very good trader, but I'd say lucky because he was always picking the bottoms and always picking the tops of all of his trades. And he ended up starting with a few $1,000s on the account. And then I think ended up building it up to like between 8 to 10 million or something outrageous like that in the space of 5 or 6 months. Just margining himself up 100%. So, it's essentially like winning the lottery, really. But yeah, it's happened. As I know it's happened once before. I haven't heard any other stories like that, but I can promise you that story is 100% true, and all in such a short space of time. And
what was he?
I think he ended up losing. I think he was trading indices, but it was when you could just open up an account and you'd get 500 to 1 margin straight away, and he was just winning basically every trade, picking the tops and bottoms. But that because he was picking the tops and bottoms, he definitely got lucky. No, none of the best traders in the world can even pick the tops and the bottoms. So, but this I wouldn't advocate to do that at all. But it has happened before. He actually ended up apparently giving a lot of it back as well after that. So I don't think he ever did buy the yacht, to be honest.
He's definitely a trader, mate. If that's what he does.
Yeah. Yeah.
Now,
nice. Well, go down.
Yeah, I was just going to say, theoretically, if you had to pay out that 8 mil, how do brokers feel about that?
Yeah, well, it's as I said, there's a lot of hedging that goes on. So, if it's it was at CMC, but CMC wouldn't be paying that out of their own pocket just to go, here's 8 million. As I said, there are risk limits, so in that instance they would lose some money. They're willing to take a little bit of risk, but they wouldn't just be paying 8 million straight out of their bank account like a betting company at all, because there would have been natural hedging from other clients. If he was breaching risk limits, they would be going to the market to hedge that, so that if the client does win all that money, they don't lose all of that money, essentially. So it's, as I said, it's a very I was going to say trustworthy, but I think that's a rubbish thing to say. If a client, you've got $8 million in your account and you withdraw $8 million, there you go. It'll come. Yeah, I don't know how that would be processed.
Yeah.
I don't know if that's a normal bank transfer or not. I'm not lucky enough to be worrying about 8 million, unfortunately. But yeah, no, I don't think he did withdraw the money. So I think he ended up withdrawing 1 or 2 million or something like that. But yeah, he ended up after that just got unlucky and ended up going every time he was just trading bigger and bigger and bigger. So he was going 100% margin every single time. So the more money he had in his account, the bigger his trades could be. Yeah, so it was just sort of like an exponential up, and then I think a very sharp down, and then he was like, right, I'm walking away while I still can.
I like it. That's a good story.
So I don't know if that's also a horror story, for him, building up to 8 million, losing 6. Oh God,
yeah.
I suppose he was still up at the end of the day, So.
Yeah. Wow.
All right. Well, if anyone else doesn't have any more questions for Conor, thanks for coming on, buddy.
Yeah, no worries. But I didn't get to show you those charts, unfortunately. I completely forgot. But yeah, it's, I can show you it just very briefly, and it just gives you.
Can you share your screen?
Yeah. Share screen.
Just while you're loading that, Connor, are you
Yeah.
for your longer terms? Are you like a fundamentals guy?
Yeah, a little bit. Like we have some access to some sort of research. I read a lot of what analysts look into as well. I'm not like a fundamental god. I don't know 100% what I'm talking about in that term. So I read a lot of what analysts are saying. What their sort of predictions are, and make my decisions based on that. And then obviously there's a few stocks that I just like the look of. And I'm like, yeah, all right, then why not? Let's see what happens. So a few things, obviously I like to just dabble in things that I like as well. Who doesn't? All part of the fun, I suppose. But yeah, so this is like an example of we were going to work with this data provider, and they've got a lot of brokers you can see on here. IC, Axie, IG, Pepperstone, FP. To name a few, as you can see, and they're all on here. It doesn't go, you can't see too much, but you can see here, this is on a non-farm payroll, and this is on gold. So this was all the way back in April, so this is fairly old data, but it's all correct. And you can see here, so NFPs come out right on the middle here. So you can see how spreads can blow out from 0.5 all the way up to 5. So that's like the spread 10xing. In that period of time. So it gives you a good idea of like when you are filled on a bad price, why that is, because brokers are doing this to the price. And you can see here on a much wider chart, like really how big a spike that is. And funnily enough, that's IG there with the widest spread at the very, very top. And then you can see CMC markets is one of the second biggest as well. So I shouldn't be bad mouthing my old firms, but they are expensive brokers, but they're still very good at what they do.
I think this was actually
talking about earlier.
Can you just mute yourself, Conor, for a sec? I think this was actually the NFP that I first spoke to you after, and you gave me some advice because I traded it on IG, and I got managed to get a little bit back from him based on your advice. So thanks for that. But yeah, if anyone, you guys, Ziggy, Dan, Bo, anything else for Conor?
I'm happy.
No, awesome. Yeah, no, that's great. And thanks to Dan and Ziggy for jumping on as well. So had a lot of fun. It's always more fun playing with others. So have to do it again sometime.
Definitely, mate.
Yeah, no, definitely.
Awesome.
Like it's always, pick my brains. If you've got any more questions as well, Marto can send you my details, or Marto can pass the questions on to me. Happy to discuss what I can, of course. And thanks for joining. It was a good session, I think.
Perfect.
Thanks, Connor.
Hope I didn't bore you guys.
No, it was good.
No, it's great.
Yeah.
All right, fellas. Chat soon, hey?
See you later.
Cheers, guys. Have a good one. Thanks a lot. Bye.
Yes.
Cool.
Nice.
That's interesting.
How do you think that went, mate?
Yeah, it's good.